It is time now for our Muni Moment, and Eric Glass here, of course, a portfolio manager over at AllianceBernstein. One of the big things that we've seen within the Treasury market is that flattening yield curve that, of course, is now inverted. The Muni yield curve also very, very flat. Is there any read-through from sort of the panic, if you will, from the Treasury side that comes over into the Muni side?
Well, first, thank you for having me. Appreciate the conversation. And in terms of going back to 1990, the Muni yield curve, the average steepness of that curve has been about 250 basis points, and so now it's about 100. So that's about 1.5 standard deviations rich. So obviously, with that yield curve flattening, investors aren't really getting compensated to go out very long. So for us, in terms of our high-grade investments, we're really focusing on the 3 to 10-year part of that curve. All that being said, Munis are in the midst of a huge technical trade. I mean, there's just, we just experienced our 20th week of 20th straight week of massive inflows, actually, and there's very little issuance from a new issue perspective to sort of suck that up, and so this is what you get. This is just a supply and demand issue.
So talk to me about another trade that you're looking at, and that really relates to infrastructure, and of course, sort of, we probably won't get a big plan from the federal government between Trump and Pelosi, but you are still finding ways to invest in infrastructure. What infrastructure do you like and do you not like?
So with the portfolio that I manage, which is an impact portfolio, what we're trying to do is promote basically mass transportation. Yeah. That's what we do. So from a negative perspective, what we're not investing in, which makes a lot of sense, would be like toll roads, right, and airports. If you think about what an airport is basically they took a bunch of marshland, covered it with concrete, and then took airplanes, which is probably the dirtiest mode of transportation, and all the ancillary chemicals that go with that, and sort of rinse and repeat in terms of a landing and a takeoff thousands of times a day, et cetera, et cetera. So we're not investing there, but what we are investing in is, again, mass transportation. So someplace like MTA, we're here in the city, and everyone sort of grouses about delays and lines that break down, but in the grand scheme of things, when you think about what the MTA does, right, they're responsible for avoiding 17 million metric tons of greenhouse gas emissions on an annual basis, which is like 3.5 million cars.
Quickly here, of course, we're also seeing a ton of rain out in the Great Plains in the Midwest, which is hurting some of the commodities. What does that mean in terms of how you're investing to protect against climate change?
So climate change is really important to the way in which we invest. Inherent in every one of our inquiries when we engage with issuers is climate and how are municipalities becoming more resilient and mitigating and adapting to climate change. Some of the things that we've decided in some instances to make investments where we will restrict our maturity out to 5 years, just as a way to protect us in terms of climate change, and others, with long maturities like, for example, in Florida, in coastal cities, right, we're not taking 30-year risks there.